Hi everyone, I want to thank you all for joining me this evening. It's great to have all of you here. My name is James and I serve as a market strategist at uSMART Securities. Welcome to another edition of the Talk Stock with James series. Tonight, our topic revolves around how to build a resilient investment portfolio. This evening's topic differs slightly from our usual focus on individual stocks. Instead, I thought it would be beneficial to discuss how to construct a portfolio using the stocks we have previously introduced. However, due to the complexity of the portfolio construction, it will be challenging to cover all the details within a short 20-30 minutes webinar. Therefore, I will delve deeper into portfolio construction in my other future webinar. I am conducting this Talk Stock with James series every alternate Thursday, 7:30 p.m. The next one would be 3rd of August. Furthermore, once the portfolio construction webinar concludes, we will be uploading the replay. You can access the replay on the Talk Stock with James YouTube channel. While you are enjoying the replay, please also subscribe to our YouTube channel, Talk Stocks with James. Let me begin with disclaimer first. This presentation is presented to you for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of the future performance. Allow me to share with you some essential points when it comes to creating a portfolio. These key factors include understanding yourself, making ample market assumptions, choosing the right portfolio strategy, and lastly, market timing. It's crucial to have a clear understanding of your financial goals, risk tolerance level, investment time frame, and overall investment objectives. Conducting a self-assessment in these areas is important as it will provide valuable guidance during the process of portfolio construction. For instance, let's say you intend to create an aggressive portfolio targeting a 30% return. However, if your risk tolerance level is low and you are unable to accept a drawdown of more than 10%, it's important for you to acknowledge this misalignment. Because a significant number of stocks have experienced drawdowns exceeding 40% over the past 10 years. So it's highly possible that you would be inclined to cut losses and find it challenging to remain invested if you cannot accept a larger drawdown. Therefore, it's crucial to construct a portfolio that suits your risk profile, risk tolerance level accordingly. And today, we probably do not discuss too much into the understanding yourself part. Let's move on to making market assumption. I believe it's crucial for every investor to make certain assumptions in order to determine how to position themselves, essentially creating a playbook. For instance, if your playbook plays out correctly and you have already positioned yourself accordingly, your portfolio can reap the benefits. In contrast, if your playbook proves to be incorrect, you can promptly identify which position is at loss, enabling you to rebalance and reposition your portfolio. Let me share some of the market assumptions I make for the remainder of 2023. Here, I do not list down all my assumptions. I just want to share with you some of them. Firstly, I believe there is a strong possibility that the performance of the Hang Seng Index in 2023 is a repeat of 2022. I anticipate a rebound in the second half of the year, possibly in the fourth quarter of 2023. Why do I hold this view? At the beginning of the year, analysts were highly optimistic about China's reopening, which resulted in the surge in the Hang Seng Index, Shanghai Composite, and Chinex. It was widely suggested that China would outperform developed markets like the United States indices in 2023. Therefore, Hang Seng Index saw an increase of nearly 13% in January. However, China's economic recovery has been uneven, leading to a decline of about 6% in the Hang Seng Index so far this year, which is similar to the performance of 2022. Which Hang Seng Index went higher in yellow line in 2022 in January, in the beginning of the year, and then it actually went all the way down until October 2022 itself, and only recovered in the final quarter of 2022. If 2023 follows a similar pattern of 2022, we may only witness a rebound in the China-Hong Kong market during the final quarter of the year. Based on my assumption, I have concluded that I can largely overlook China-Hong Kong for the majority of my investment this year. Instead, I may choose to allocate more towards Hong Kong towards the end of the year, as I anticipate a potential catch-up in performance during the final quarter. The second assumption I make is maybe AI will save us all. The recent rally in the US stock markets can largely be attributed to the exceptional performance of a few specific companies, namely Apple, Microsoft, Nvidia, Amazon, Tesla, Meta Platforms, Alphabet. These 7 stocks have made significant contribution to the gains seen in S&P 500 and Nasdaq 100 indices, accounting for 69% and 75% of the total increase, respectively. The primary driving force behind this outstanding performance this year is the hype surrounding AI. However, since the AI boom has been extensively discussed, I won't talk about it in great detail. In summary, AI can be considered an investment bubble, and that's not necessarily a cause for concern for now, as it could still be in the early stage. This could be still a early AI bubble, and if this resembles the dot-com bubble, stocks related to AI can continue to rise significantly before experiencing a decline. And if we use the roadmap of mobile internet adoption as a guide, the monetization of AI will likely start with chips and semiconductor-related companies, followed by devices and services. Therefore, investors may want to focus more on chip-related stocks like Nvidia initially, as the monetization of the software, such as ChatGPT or BART, may occur during the later wave of AI implementations. AI-related stock can supercharge this bull market. This could be the story for bulls to latch onto, and the big tech stocks should be the main beneficiary in this AI bull run. This is why it is good to have some big tech names in your portfolio rather than the small tech names. The third assumption I have is that US stocks are likely to continue performing well in the second half of the year. Historically, when US stocks have returned more than 10% in the first half of the year, the second half of the year has typically generated a positive return. This pattern holds true when looking in the past 10 indices where S&P 500 returned more than 10% in the first half, with the second half performance averaging around 10% itself. While I personally believe that the US stock markets may be overvalued in the short term, I do not think that it's advisable to engage in short selling at this time. It's better to be in the long positions, and hence, if you have not positioned enough, it's good that we wait for corrections before entering the market. rather than just short selling itself. And if you have not positioned yourself in the equity market sufficiently, this is why I would say that it's probably good to wait for a market correction first. Nevertheless, no matter how bearish you are, you should stay invested with at least 70% of your portfolio allocated to the market. Next, let's talk about choosing the right portfolio strategy itself. I will present some practical portfolio strategies to help you find the one that best suits your style. Firstly, let's talk about diversifications. Diversification is a strategy that involves investing in a wide variety of assets within a portfolio to mitigate the portfolio risk itself. It spreads its investments across different asset classes, sectors, regions, and market cap. The idea is that when one specific investment performs poorly, others may perform well, helping you to offset potential losses and overall help you to cushion your portfolio ups and downs. One of the simplest ways to achieve the benefit of diversification is through investing in ETF. For instance, based on your risk profile, if you prefer a conservative approach, you can allocate 80% of your portfolio to bond ETF and the remaining 20% to equity ETF. For a balanced investor, a 50% allocation to bond ETF and 50% allocation to equity ETF would be appropriate. On the other hand, if you are an aggressive investor, you may consider investing 20% in bond ETF and the remaining 80% in equity ETF. You can consider adopting a two-fund strategy, whereas you invest in two funds to create a diversified portfolio. For the bond component, you may choose to invest in I.G.Y ETF, which stands for iShares Core US Aggregate Bond ETF. This ETF helps you gain exposure to 10,000 US investment grade bonds portfolio. As for the equity component, you can opt for ACWI ETF, known as iShares MSCI ACWI ETF, All Country World Index. This ETF invests in a diversified portfolio of approximately 2,300 companies worldwide. When constructing your portfolio, it's important not to over-diversify because diversifications may only help you generate a market return. And hence, if you want some alpha, you want some extra return, you may need to incorporate some active strategies in your investment approach. And hence, some investors may opt for cost satellite approach. Cost satellite approach breaks your investment portfolio into two components, the core and satellite. The core component is designed for long-term strategic asset allocation and comprises a broad range of diversified holdings. It forms the passive investment foundation of your portfolio. It helps you to gain exposure to the overall market. Personally, I would suggest allocating 60 to 80% to the core to achieve a market return. Typically, core component has lesser volatility. They can be global stock, global bond, or dividend-paying funds. These are something that require less frequent monitoring and allow you to have peace of mind, ensuring you can sleep well at night. On the other hand, the satellite portion involves more actively managed investment, such as individual stocks and bonds or other actively managed funds. Normally, this is the part where the portfolio gets a bit more excitement and fun, as it is investing in specific thematics, sectors, or market opportunities. Satellite holdings are often considered for short-term strategies or to pursue potential outperformance beyond the market. The typical allocation to the satellite component is around 20 to 40%, depending on your risk profile. All in all, core satellite investing is an investment strategy that combines a diversified core portfolio with a selection of actively managed satellite investments. The core component provides stability and long-term growth, whereas the satellite components aims to generate higher return and enhance the overall portfolio performance itself. And lastly, let's talk about barbell approach. The barbell strategy is a portfolio approach that involves concentrating investment at the two extreme ends of the risk spectrum, high risk and low risk asset, also known as risk on asset and risk off asset. Let's talk about risk on asset first. Risk on asset include assets with higher valuations, greater volatility, and higher growth opportunities. These are investments that have potential for higher returns, but they also come with increased risk. On the other hand, risk off assets are investment with cheaper valuations, lower volatilities, and sometimes lower growth opportunities. These assets are often considered safe haven investment that provide stability and downside protections during uncertain market conditions itself. And unlike the core satellite approach, which may require active portfolio management constantly for the satellite component, the barbell approach employs a long-term strategy allocation strategy. It involves buying and then holding it for long-term and allowing for a more passive management approach. Overall, the barbell approach aims to balance the potential for higher returns from risk-on assets with the stability and safety provided by the risk-off asset itself. Example of risk-on asset include US equity, technology-related stocks, electric vehicles, semiconductors, companies, and commodities such as crude oil. Some of these sectors are considered speculative in nature due to the higher volatility and growth potential. On the other hand, risk-off assets intend to offer downside protections to your portfolio and typically includes investments in utility sectors, consumer staple sectors, healthcare sector, gold, MMF, and short-term duration funds itself. These assets tend to be more stable and resilient during the market downturns. The key idea behind the barbell approach is to imagine that you are an aggressive investor who wants to own highly volatile sectors like semiconductor and EV, despite their high prices. You believe in the long-term growth stories of these high-risk assets, and by adopting the barbell strategy, you can stay invested in a portfolio that consists of both risky asset and risk-off assets. With this strategy, even during the market sell-off itself, there is often a flight to safety into those risk-off assets, which will then provide you some cushion for your portfolio downside. And if the market continue to rally, the risk-on asset itself can potentially deliver significant returns compared to other portfolio strategies. In summary, the barbell approach helps you to stay invested in the risk-on asset for long term with the help of risk-off assets. Okay, so I have finished sharing some of the different approaches in constructing a resilient portfolio. As for myself, I'm a fan of barbell approach. Here is to show you an example of aggressive portfolio that I constructed. This is probably one of the most important slide itself. In terms of risk-on assets, I have included technology-related stocks such as Apple, Microsoft, Tesla, Amazon, Nvidia, and probably TSMC itself. For risk-off asset, I have included healthcare ETF along with companies like Costco, Coca-Cola, McDonald's, just to name a few. I won't go into detail about individual stocks that have, because I have covered most of them in my previous webinars, some of which are available on my YouTube channel. I probably will talk about them more in my Invest Fair seminar in August or in my future webinars. And if you have determined the strategy that you want to implement, the next questions that you should ask yourself is, what is the optimal number of stocks to include in a portfolio? And to give you my answer first, I believe that an ideal investment portfolio should consist of anywhere between 10 to 20 holdings, which can include both stocks and ETF. I don't think you should fall in love with every stock you come across and invest in them. In my opinion, only a limited number of stocks are truly worth holding on for a long term. And one observation I have made is that some retail investors prefer to hold on to a limited number of stocks, typically less than 5, typically 2 to 3 stocks in their portfolio. This approach can expose an investor to a significant concentration risk, especially for retail investors who may not have the same resources or risk tolerance level as institutional investors. What do I mean by that? Imagine you are an Alibaba investor and you have bought the share at its all-time high at $317, and subsequently Alibaba's share price fall by 80% to $63. So even though recently there's a rebound of maybe 52% itself, the stock is still down about 70% from its all-time high. Now, let's assume you have a portfolio consisting of 2 stocks, with Alibaba representing 50% of your total holdings. So since Alibaba is currently down by 70%, your portfolio has suffered a 35% decline solely due to Alibaba's performance. I believe this situation would insert a significant pressure on an investor. That investor will find it difficult to stay invested in that position. On a separate note, I also like to clarify that about my viewpoint on Alibaba. I do not consider Alibaba a good stock for long-term investment. Okay, for the next few slides, I would like to share with you the total number of holdings some successful investors have in their portfolios. This is to illustrate that while having 10 to 20 investment stock portfolios, like I mentioned before, is generally considered a good number, it doesn't necessarily apply to every investor. Let's take a closer look at Nick Sleep investment portfolio, which currently consists of only 3 stocks: Costco, Amazon, Berkshire Hathaway. This particular approach suggests that if you have a deep understanding of a stock and invest a significant portion of your portfolio into it, there is potential for high return, but also an increased higher risk as well. Therefore, it would not be accurate to label a 2 to 3 stocks portfolio as a bad portfolio. Instead, it depends on the level of understanding and convictions you have in those particular stocks. If you thoroughly understand a stock and have confidence in the prospects, I would say that concentrating your investments in a few selected stocks can potentially yield higher returns, but again, it also comes with greater level of risk itself. Now let's look at Warren Buffett's Berkshire Hathaway's holdings. Currently, he holds 47 stocks in his portfolio, indicating a fairly diversified approach. However, Warren Buffett is also known as being a conviction investor. For instance, he has strong conviction for Apple share, which make up 47% of his portfolio. His top 5 holdings consist of Apple, Bank of America, American Express, Coca-Cola, Chevron, accounting for 77% of his total portfolio. In summary, while Warren Buffett's portfolio is diversified across 47 holdings, he demonstrated the willingness to allocate a significant portion of his fund to companies that he truly believed in. Next, I'd like to talk about Terry Smith. Terry Smith, often referred to as the English Warren Buffett, maintains a portfolio consisting of approximately 40 stocks. There are 2 reasons why I want to highlight his portfolio. Firstly, he is one of my favorite investors. And secondly, I find his holdings interesting. His portfolio includes companies that I personally may not be familiar with, but are worth exploring further. For instance, he invests in healthcare companies like SkyCare, I.G.Y, and consumer staple stocks like McCormick, and human resource management software company Automatic Data Processing. These are typically lesser known companies that you do not normally see in one's portfolio. Lastly, let's look at the portfolio of another legendary investor, Ray Dalio. In his Bridgewater portfolio, Ray Dalio holds a significant number of holdings, 710. So if 710 holdings are not considered a lot to a great investor like Ray Dalio, who am I to criticize you for wanting to hold 700 holdings in your portfolio? Ray Dalio's investment strategy set him apart from other fund managers as he tends to allocate a larger portion of his portfolio to ETF holdings. At times, his ETF holdings can be as high as 50%. Currently, he holds approximately 15% of his holding of his portfolio in ETFs, including emerging market ETF, S&P 500 ETF, some China's ETF, among others. Okay, the last part of constructing a portfolio involves market timing, which include understanding of technical analysis. However, discussing technical analysis in detail would require many additional webinars, so I won't talk about it today. Instead, I would like to share with you 2 investment strategies related to market timing. Strategy number 1, split your investment into 3 tranches. Okay, for example, if you want to invest 300,000 in the market, allocating the first 100,000 in the stocks into the stocks according to the composition here is good, according to the composition weight of your portfolio itself. This initial investment allows you to capture some market returns, whether the market goes up or down. At this stage, you already allocated at least 100,000, at least 1/3 of your portfolio into the market itself. And for the remaining 2 tranches itself, invest them in the market when the share price goes up or down by 10% to 20%. If the market is down 10%, invest another 1/3 of your money. And if it's dropped further by 10%, invest the final 1/3 according to the weight that you decided for your portfolio. Strategy number 2. Okay, this strategy is a bit more complicated. Firstly, you need to identify stocks that you believe are trading nearly their lows or gaining momentum and decide and invest fully in them. For instance, if you have $300,000 to invest, and certain stocks like C Limited, Meituan, Tencent are trading near their lows, so it may be worthwhile to invest fully into them. For example, you can fully allocate 1% of your 300,000 portfolio into C Limited, which amounts to $1,000. Yeah, sorry, this calculation I think is, yeah, it's wrong. Okay, so on the other hand, but typically the idea is you just invest 1,000 of 300,000, which is $3,000 fully into C Limited. On the other hand, for highly volatile and overvalued stocks like NVIDIA itself, if you intend to invest 7% of your total portfolio in NVIDIA, you can start by investing 3% first and wait for better market timing to invest the remaining 4%. So both strategies, be it strategy number 1 or strategy number 2, involve a prudent approach to market timing itself. And eventually, I believe this will help to construct a better, resilient investment portfolio. Okay, I shall end my presentation here. Please subscribe to our channel, and I will be uploading this webinar in the next few days. Okay, and now let's proceed to the Q&A sessions. So please type in your questions in the Q&A box, and I will try to answer all of them. Okay, first questions. Why don't you include Singapore stocks in your portfolio? Okay, it's a good question. I do not include any Singapore stocks because I was thinking to conduct a Singapore stock portfolio seminar separately. This is reason number 1, and I think most of you are probably familiar with Singapore stocks that you do not require much of my help to share with you more about it. Many other analysts have covered local stocks, and I think a lot of since a lot of local analysts has covered much, you probably have heard much about it, enough of it. So what I intend to do here is to share with you more about foreign stock portfolio that probably other analysts do not cover much. Okay, this is another good question. What is your cut loss strategy? Is 10% a good cut loss strategy? I would say I probably won't give it a number. Like I won't say, oh, because the stock price plunged by 10% or 20%, you should cut loss. Instead, I would say you should consider other factors. I would say firstly, if there is a fundamental change about the company that the future earnings growth trajectory is totally changed, then and such changes diverge greatly from my initial assumptions, it should warrant cutting losses. Secondly, I will look into the market itself to see if there is a more attractive opportunity. For example, Disney share price has dropped more than 50% from its high, but I would not say that Disney is a bad investment, because I would say Disney current share price look fairly valued. But if at the same time Tesla is worth $100, then I will say Tesla presents a more promising opportunity since Tesla is trading at $100. Ultimately, the decision to cut losses should be based on a lot of factors rather than falling prices itself. Okay, why SMH ETF? Yeah, good catch. I include, okay, I can't remember what is the full name of SMH ETF, but I include SMH ETF in the portfolio itself. Okay. So the reason to that is that I normally prefer SMH ETF due to a lot of reasons. I would say reason number one, the share price is cheaper for SMH ETF since it's trading at about $150. SOSS ETF is trading $500. So it allows me to actually allocate my allocation more closely to my desired weightage if I choose to include SMH ETF rather than SOSS. Secondly, the liquidity for SMH is typically better. The AUM is higher at probably 10 billion. It's about 1 billion difference between SMH and SOSS ETF, if I'm not mistaken. And the trading volume for SMH is larger as well. And the third reason is the number of the holding itself. SOSS typically holds more Intel, but lesser TSMC. But SMH ETF holds more TSMC, lesser Intel. And I prefer TSMC to Intel. This is why SMH is my top choice. Okay, all my China stocks are crashing hard. Should I let go at 50 to 60% loss or should I buy more? I think it depends on which China stocks you are holding. Like I previously mentioned, you probably would like to cut loss when there is a revenue growth disruptions in the long term, or if there is a fundamental change of the companies that your investment thesis is no longer holds, or that is a better investment opportunity. Because sometimes good companies also fall in prices. So it's a tough question that I don't have a perfect answer for you. And I also cover some of the good China stocks in my webinar before. I think examples of good China companies include Tencent, Meituan, Pinduoduo, and maybe what is important is in the short term, the share price itself reflects the investment sentiment, but in long run, share price reflects the company fundamental. So good companies typically will perform better in long run. Having said that, it really depends on your investment objective and the quality of the underlying companies itself. Okay, should I sell my Hong Kong shares now and come back during the last quarter? Okay, so typically my market timing probably is not as good as other trader itself because I'm a long-term investor. So I would say that it's probably a bit too late to sell the Hong Kong shares now, in my personal opinion, and come back during the final quarters, unless you really anticipate that the Hang Seng index will go back down to 14,000, and then it will recover from there. So in last year, it actually recovered 5,000 points when it fell to 14,000 plus in October, and within 2 months time, it actually recovered about 5,000 points. So it actually surprised all of us itself. And I would say that will we see the similar run of 2022 in the final quarters? I really don't have a good answer for that. But again, like I mentioned, some of the good companies like Tencent, Meituan, and Pinduoduo is quite fairly valuable. If you are a long-term investors, the share price probably is still down 50 to 60%. But I would say that in long run, the share price will reflect the fundamentals itself. And then again, I also see that I believe the index price is near to 19,000 now, which I think 19,000 is also a good support level itself. Anything below 19,000, right? I think I really do not know what will happen, that it break down again to lesser than 19,000. But I don't quite see that it will fall to 14,000 again. Yeah, I hope I answered that. Okay, am I too late now to invest in NVIDIA? And what is the upside potential at this price? Again, it's a tough question. I think the most important question is, do you really like AI exposure? And do you have enough AI exposure? Because if you like it, NVIDIA is currently the best stock to gain exposure. Again, the underlying reason is that instead of investing in a gold mining company that may or may not successfully extract gold, it is more beneficial to invest in a company that supplies the tools for gold mining, which in this case is NVIDIA, which act as a gold shopper company. A better question is probably, is current share price of NVIDIA overvalued? The answer is yes. Is this a bubble? Yes. Considering some of the AI interests like ChatGPT is coming down, but this could be the early baby bubble that we witnessed in early 1999 before it burst itself. So I would say that if this is a repeat of the dot-com bubble, that the stock price could still run up a few hundred more percent before plunging down. So again, my thesis is never say never itself. Again, one of the better investment strategy is, maybe you would like to gain a little exposure. First, instead of investing 10%, if you decided to invest 10% of your money into NVIDIA, you may just want to allocate just 2 to 3% of your portfolio weights into NVIDIA first, rather than go all in at the current share price. What is the upside potential? I really have no answer for that at this moment. But yeah, I think I covered NVIDIA in the last webinars. I would say that the fair value is about $280. So will I be surprised that it finally corrected to $280 before finding a good support? Yeah, that is a possibility. But the question is, do we really want to wait until it falls to $280 and then enter the market? I would say that it depends on your investment strategy. Okay, yeah, sorry, probably one last question. Hi James, how do you consider options trades as our investment portfolios? Yes, it's a good idea. For example, if you are using a core satellite strategy, options trading should be considered as one of the satellite component. I would say that typically for option trade, every option trader know that option is not really for the long term, but this is just investment strategies that give you to help you to enhance your portfolio return itself if you time the market well enough itself. Okay, so again, I've answered most of the questions. Happy trading, happy investing, and I thank you all for attending tonight's webinars. I shall see you in 2 weeks' time or during the Invest Fair. Okay, thank you all. See you all.